After the Federal Reserve's interest rate cuts, U.S. Treasury yields have continued to rise, resulting in falling bond prices and a decline in the U.S. Treasury ETF, TLT. So, is now a good time to buy the dip in TLT? First, let's briefly revisit the reasons behind TLT's decline and the rise in U.S. Treasury yields, which I have elaborated on in previous articles. The Federal Reserve's reduction in the federal funds rate mainly affects short-term Treasury yields, while TLT tracks long-term U.S. Treasuries with maturities of 20 years or more. The yields on long-term Treasuries are primarily influenced by the outlook for the U.S. economy. The better the U.S. economic outlook, the more likely long-term Treasury yields will rise, causing TLT prices to fall. Conversely, if the U.S. economy slows down, long-term yields typically decline and TLT prices rise. Last Friday's U.S. non-farm payroll data surprised on the upside, with revisions to previous numbers and a notable improvement in the unemployment rate to 4.1%. This significantly reduced recession expectations, and in light of the improved economic outlook, TLT dropped while Treasury yields soared, with the 10-year Treasury yield once again surpassing 4%. Additionally, U.S. Treasury prices are influenced by supply and demand. If the supply of a good increases while demand remains unchanged, the price will fall. Recently, U.S. Treasuries have faced this issue as the U.S. Treasury Department continues aggressive debt issuance, pushing the scale of U.S. Treasuries to new highs, which has contributed to TLT's decline. So, will Treasury yields continue to rise? Is now a good time to buy the dip in TLT? This largely depends on whether the U.S. economy can remain strong and whether the U.S. Treasury Department continues its aggressive issuance. The latter is beyond the scope of our financial channel, so I will focus primarily on the former. Here, I refer to a Bloomberg report. Bloomberg outlined 5 possible scenarios for the U.S. economy, each with associated probabilities and implications for Treasury yields and the federal funds rate, directly impacting TLT prices. These 5 scenarios are: 1. A hard landing, meaning a severe U.S. recession. 2. Stagflation, where the U.S. economy slows while inflation remains elevated. 3. A soft landing, where the economy slightly cools and inflation returns to lower levels. 4. No landing, which is currently viewed as the most likely outcome, where inflation remains above the Federal Reserve's 2% target while the U.S. economy stays at its current level without entering a recession. And 5. A re-strengthening of the U.S. economy. With the 10-year Treasury yield currently at 4%, if the U.S. undergoes a hard or soft landing, there could be room for yields to fall, presenting upside potential for TLT. On the other hand, if the U.S. economy strengthens, experiences no landing, or enters a stagflationary period, TLT may offer little profit. Readers should base their decision on their own assessment. For example, if you believe the U.S. non-farm payroll data is manipulated and that the U.S. is already in a recession, then TLT could be suitable for you. Conversely, if you think inflation remains stubbornly high or the economy is stable and improving, it may be wise to stay away from TLT. This article is merely a record of my personal thoughts and does not constitute advice for others.